Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today I would like to discuss one new article we have on the blog. It's called Trading as a Small Business, What Beginner Investors and Traders Usually Learn Too Late. It's a short blog that's built on the email conversation that I had with one of our clients who is starting. It's a very good article in my opinion, and it's about if you are starting with the trading, what are the common mistakes that you will probably make and how to treat the trading as a business and not as a gambling. So let's discuss the article. So a lot of the traders that enter the market and they start trading, it's not important whether it's discretionary trading or quant trading, they have the assumption that they study hard and find the right indicators or right strategy, they will be able to have big returns with a small risk. There are a lot of influencers that will show you great performance, great backtests, etc., etc. In reality, significantly harder.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
One of the most important lessons for the beginner is not to look for the strategy build indicator, optimize trades, entries, etc., etc. It's to have the correct mindset or framework or expectations. So, the trading is like the business. So it makes sense to have the perspective on the business. So, do not expect a lot from the first years in the market. You should have realistic expectations. And what are those realistic expectations? So the first mistake is if you do not have expectations. So the common benchmark for the performance to risk ratio is 1:1. If you see the strategies that have 50% performance, it's a 10% drawdown, and it's absolutely unrealistic to have this strategy running for the long term and not to have a higher drawdown or lower performance. So there is a great article. It's called Where All of the Sharp Ratios Over 1 Are Gone. And it's an article from Eben Faber. I really recommend that article to you. It's a little older. A little older means it's 17 years old, but there is no new findings. So the article is about what is the reported performance and the risk. At the end, it's a Sharpe ratio of the funds that existed at the time and what is their Sharpe ratio over more years. And as you can see, on the period of 10 years and more, there is no fund with a Sharpe ratio higher than 1, 0. Absolutely not. So all of the funds that have longer history, or so 10, 15, 20 years, all of them have Sharpe ratio less than 1. Most of them, between 0.5 and 1. So what does it mean is if the best funds in the Wall Street are not able to have the Sharpe ratio over 1 in the longer period, you will not be able to have it too. What is important to have is to have realistic expectation. So if you would like to have 20% performance, you can expect 20% drawdowns of volatility. If you have 40%, you can expect 40% drawdowns of volatility. Then we are going to the second mistake. Overestimating risk tolerance. So most of the traders, when they start trading, they imagine themselves that they can handle more risk than they can actually can. That's really a problem. And especially true during the bull markets, everything is rising, prices are rising, there is a lot of optimism in the market. So the pullbacks are brief, drawdowns are low. So the beginner will tell you, I can tolerate 50% drawdown, 40% drawdown. And it's not true. You will not be able to tolerate 40% drawdown or 50% drawdown because it's a significant difference between imagining drawdown and living through a drawdown. I met a lot of traders, all of those traders, they had a drawdown for 1.5 years or 2 years, and they are trading for 20, 25 years, and still they had a drawdown for 2.5 years. And living through the drawdown of 2.5 years, seeing it in a chart are absolutely two different things. Take your expectations about your risk tolerance and think about them, really be realistic. So you will not be able to tolerate 50% drawdowns. Maybe 10, maybe 20% is normal. Most of the people tolerate drawdowns in this area. And then we are returning back to the first mistake. If you expect or if you will realistically tolerate drawdowns 10 to 20%, you cannot expect to get from the trading 50% per year or anything like that. If you want to have those strict risk management and you, really take this as a business. However, the biggest structural mistake beginners make is copying the mindset of large funds without realizing that their own size is actually an advantage. So what does it mean? The funds are trading something because they are big and they need to have the strategies that are scalable, that trade liquid stuff, etc., etc., because they have substantial amount of the capital. However, when you are independent trader, you are small retail trader, you can trade differently. So you can trade something that's less liquid, that's less efficient, niche market or anything, something that the funds will not touch, and that's your edge. actually. When you are trying to build something, I mean, you can think about the strategies that are less crowded. And we have some examples, the Soccer's Club stock arbitrage. So it's a strategy for small traders. You can arbitrage the performance of the soccer stocks that are listed on the market, and you can arbitrage that with the actual performance of the soccer club, how it's faring in the game. You can, evaluate reversal potential into niche alternative ETFs, etc., etc. So, there are a lot of the strategies that you can explore that are on an inefficient market. However, there is usually problem with limited liquidity. Even for a low trader, you must have a good model for entering and exiting the market via the limit order, not crossing the spread. So the execution transaction cost must always be considered. However, those markets are inefficient because they are small and the big funds are not there. It's significantly better to trade in those markets than try to trade like S&P 500 future or whatever. All of the big hedge funds are sitting there. Try to imagine if you find alpha there. The trading is a business, so it's not a lottery ticket. Try to imagine that you are entering the market the same way as you are entering any other business. If you want to coffee shop, you will not start to manage 20 Starbucks from day one. So you will start some small local coffee shop, learn how to run it properly, learn from day to day, learn how to take care of the customers, what the customers want, what are the times when they enter the cafeteria, when they exit, etc., etc. So you start to learn something in the small scale, and then you are scaling up and can buy more cafeterias, small local cafes, etc. At the end, you can manage something like, 10 Starbucks or whatever. And the same logic applies to trading. As a small retail trader, you should start with something understandable, narrow, small, niche, one market, one setup, repeatable process, one source of edge. And then goal is not to earn a lot of money. The goal is survive, learn something, and then you can start scaling. So not the maximum growth, but learn something. Once you have the results, once you have something after you, once you understand execution, once you understand all the problems, you can scale up, etc., etc. So that's trading like a business. Do not start with all of the money right from the beginning. It will not end well. I saw it a lot of the times. What the trading like a business actually means. The capital is your business capital. So it's not entertainment money. You need to have the realistic revenue expectations. So it means you need to have realistic expectations. What are the returns that you can have? You need the specialization. You don't need to trade everything. You need to find a niche and trade that niche. Then you need the risk controls before the growth. So you need to take firstly care of the risk. You need to understand, what are the drawdowns that you are able to tolerate, and there will be drawdowns in the future. Do not overtrade. And finally, you need the patience. It will take longer. You will need to learn a lot, but you will not learn by swinging right from the fences with a 50% drawdowns and trying to have 100% yearly performance or whatever. So start slow. A lot of the traders would like to start with machine learning. There's a lot of the tools that you can use, from Claude to ChatGPT to hundreds of agents, etc., etc. It's the same trading with AI and machine learning than trading discretionary or trading systematically the other way. There are a lot of the problems like memorization, etc., etc. Once again, start slow, have a realistic expectations. There is even bigger problem when you run the machine learning strategy about the over optimization of the results. Results seems better than they will be in the future. Believe me, I saw that a lot of the time. The machine learning can make your backtest performance look absolutely optimistic, really nice, but it's not true. So you need to set up expectations right. So the risk management is the real foundation of the trading. Really. Then if you have like one working strategy, you can combine multiple strategies together. You can build a portfolio like we described here, combine in the article how to combine multiple calendar strategies into one trading portfolio, etc. So you can start with a small one strategy, small niche, and then you can build on top of that. This video is a little different from all of the other videos that we have on the channel. So we are not discussing one particular strategy. I'm not trying to explain you how does it work or some new academic research. It's really from the experience. We are receiving a lot of the emails from our clients, and we decided that we will put, instead of explaining and replying always the same answers, we decided to put them into one coherent article. So I hope that you like this video. I hope that you like the article. Visit our blog, go through the article. There are more things in the article that I mentioned in the video. And if you are interested, go through our database. We have a lot of the trading strategies you can pick from. You can learn a lot. You can find your specialization, and also visit our blog, subscribe to our channel. I hope that you liked the video, and we will see each other in the next. Thank you.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.